Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne with David Ingles.
Good morning. Let's get to your top stories today. Stocks across the Asia Pacific are edging higher as traders await key U.S. and Chinese data this week. Possible extension as well to Beijing's tariff deadline. Oil declines ahead of President Trump's summit this week with Vladimir Putin.
Nvidia and AMD said to agree to pay 15% of their China chip revenue to the U.S. government as part of a deal to secure export licenses.
Also ahead, lithium stocks jump as CATL suspending operations at a key mine after failing to get a permit renewed.
Plus, we take a close look at China's campaign to rein in a fierce price war among businesses as deflationary pressures persist.
Right, the market narrative is changing somewhat from about an hour back, and it's important to keep in mind Japan is shut. You don't have a big bulk of volume so far. We'll see how that changes when Greater China opens up. 0.2% is the open in Taiwan. I think the story when you look at equity markets is undisturbed by the Nvidia news, which we'll get to in a moment. As you can see, U.S. futures are punching slightly to the upside. Very quickly, let's have a look at FX markets, where it's really, depends where you look, but on the euro side of things, the euro is stronger. The dollar, though, against almost everything else, is slightly on the stronger side of things. Of course, the weighting on the euro will do that to you. As you can see, dollar-yen is on the way down. Bond futures are flat, if not to the upside, when you look at the long end of the curve here. We'll get to the preview of inflation numbers coming through on Tuesday. Out of the United States, so we're coming off some lackluster inflation numbers coming out of China. This is a big story, of course, we're tracking in the commodities markets. Two things. Brent, on the prospect of more supply coming to the market, number one. Number two is gold. We're still waiting for more clarity coming out of the White House on really what the policy is as it pertains to tariffs, if any, on futures coming in. Iron ore in Singapore, just to point out, flip the boards please, is now trading at a multi-week high. The approach to the open, it's a big earnings week. A50 futures to the upside, dollar China just a touch below that 719 handle, Yvonne.
Yeah, pretty pivotal week when it comes to Chinese equities. You take a look at what you said. You mentioned about what we're seeing in earnings, the likes of the Alibabas, the Tencents of the world will be reporting this week as well. You add that to the fundamental picture and the data dump to end of the week. Certainly that is going to be a sign of how things are going to lead to the direction of markets are concerned, right? Because you have a bit of corporate feel. You also have what happens in the data front as well. So that's going to be pretty interesting, Dave, I think. Yeah. But when it comes to what we saw so far, the inflation numbers or the lack thereof still in China unchanged. But there were some signs of those deflationary pressures easing still.
Yeah, well, you have to look really close.
Very close.
Very, very close, right? I think Goldman Sachs had a very good point when you look at it, is that you really will need to see demand side pick up to be able to sustainably make a conclusion that that's going to go away. And I think what Goldman's also going to tell us later on is when you look at things like to the housing, the monthly activity numbers coming on a Friday, they're saying high frequency numbers on home sales, auto purchases, are suggesting weakness in that space. So we'll look at what that means, and of course, a commentary coming out of the big earnings coming through this week. The other big news out of China will be lithium.
Yes.
Given CATL, that announcement a couple of minutes ago, and of course the reporting we had. So we're looking at this whole cohort of lithium-related stocks on the back of that output curve.
Yeah, I mean, the CATL just confirming our reporting of that Bloomberg scoop about them halting their operations at the Yichun mining as this permit expired last week on the 9th. So they're seeking to renew it. But yes, for now, the Yichun mining halt has limited impact on operations so far. But it really kind of coincides, this whole permit issue, with the whole anti-involution theme, overcapacity and the like. So the timing of it is quite interesting.
Yeah, and I wonder if we can put those two things together. We could actually see, we will get market reaction, as you can see on your screens. Lithium stocks across the region are lit in many, many ways. Okay, so that's one sector to watch. We talked about chips and Nvidia. Gold is one thing. We talked about this. They were still waiting for more clarity as far as what the White House is looking at there as far as policy goes. And of course, food. The reason we bring that up is the inflation numbers which came out on the weekend. So food, alcohol, alcohol and tobacco actually saw quite a decent drop, negative 0.8% that came out in the inflation numbers coming through.
Okay, so maybe that helped a bit in terms of making the numbers a little bit better. But then again, PPI prices, right? We're still talking about 34 months of deflation that persisted in the factory floors there. So you're still seeing, corporates are not able to really pass on some of these rising costs and the like to consumers as well. In terms of your agenda here today, so we talked about that. We're in the window for credit data in the next few days as well before that data dump. South City is a liquidation hearing later on today as well. As we said, earnings. So it certainly is one thing to watch this week. A little bit of everything. Let's talk a little more about top story here right now. Bloomberg has learned that Nvidia and AMD have agreed to pay the U.S. government 15% of their revenue from Chinese chip sales as part of a deal to secure export licenses. Let's bring in our China correspondent, Min Lo, on what we know so far about this.
Yes, this was first reported by the FT, and we understand it came after Jensen Huang met with the U.S. president again, and then after that, the export licenses for the H20 chips were finally granted after a few weeks of stalling by the U.S. Commerce Department, and it seems like now these two companies, AMD and Nvidia, had agreed to give the U.S. government 15% of their China sale to the government. It's not clear what the U.S. government will use that money for, but it's a sort of quid pro quo agreement that is quite unprecedented, and it really sets a new sort of standard for the types of compliance costs that companies dealing with China could possibly face. It also raises a question as to whether or not the U.S. government is willing to trade off security concerns by rolling back even more of these export controls in exchange for a cut in revenue from some of these tech companies.
This social media account tied to state media urging consumers to avoid Nvidia chips. What's that about?
Yes, this is on the Yuyuan Tantian WeChat account, which is tied to the Chinese state broadcaster CCTV. And it's a very long post detailing how the U.S. has the ability to install backdoors into U.S. chips like the H20 on both the hardware and the software front. And it can do things like, number one, remote shutdown of the chips. Number two, monitoring of usage activities. Number three, location tracking. And number four, restricting usage on these chips. And it says that basically the takeaway there is that Chinese companies need to be very aware, and all countries, in fact, need to be aware of that and to build up their own sort of secure and controllable software and hardware ecosystem to counter what they see as AI hegemony from the U.S. And so this is a warning from state TV, a sort of window guidance for Chinese companies, urging them not to buy those chips, not just because of the security risks there, but also because, number one, they're not energy efficient as well, and they're not the most advanced chips that Nvidia can offer, so there's no reason that Chinese companies should be buying them. And it, of course, could be a hit to Nvidia's profits, given that we know the company had been lobbying very hard to sell these H20 chips to China, but now the state TV is really discouraging that.
Mimit, I want to get to another story, because we're seeing lithium, anything that's related with lithium now is up. Guangzhou lithium futures, according to traders that we're talking to, are up by the daily limit of 8% right now on the back of the CATL story. It's interesting, the amount of interest, even leading up to this announcement, where people were flying drones around this area just to gauge what was going on. What do we know at this point?
Yeah, because this particular lithium plant is a very important one. It accounts for at least about 3% of globally mined lithium. And so the fact that CATL has not been able to renew the permit, that is raising speculation about whether or not this is part of the anti-involution push, right? And while the company is still in talks with government officials to renew that permit, which could take months, it's not clear whether they will get that renewal. And so we had already seen a lot of volatility to lithium prices in recent weeks. It was up about, I believe, 9% or so last week. It hit a high in late July, about 80,000 yuan, before the Guangzhou Stock Exchange actually clamped down on speculative trading. But if you take a long view, you look at where we are now compared to the peak a few years ago, 2022, we're still about 7 or 8 times cheaper in terms of lithium prices compared to then. So there's a lot of supply glut that has built up over the last few years that has been very bad for lithium producers. The impact, though, on CATL and these battery makers is a little bit more complex. We see a market reaction on the lithium companies, but then for CATL and other companies, it could hit their profit margins. But it seems like investors still seeing this as a positive for CATL.
All right, Minmin, thank you, Minmin Lo there, of course, on all things that we're covering here this morning in terms of market-moving news. CATL, also those shares are indicated higher in Hong Kong. We'll give you an update once we get that pre-market opened up as well. Let's get to another story. We have to talk about what's going to happen in Alaska as well. NATO Secretary General Mark Rutte says that this week's U.S.-Russia summit may open the door to negotiations about Ukrainian territory. Meanwhile, sources say EU nations are seeking to talk to President Trump before his meeting on Friday with Vladimir Putin. For more, let's bring in our news desk editor, Balazs Pence. On more, there's a lot of speculation that, maybe we are getting close to the end of some sort of, with the war, and maybe even the prospect of more supply heading into this oil market, too. What's expected today?
Well, this certainly has been a very fast-moving story since that summit was announced in Alaska that we're preparing for at the end of the week. And what we're seeing now is the opinions from all sides, all the interested parties coming in. What we're hearing from Mark Rutte, the Secretary General of NATO, is that it looks like some territorial exchange might be on the table, that there might be a recognition that the current battle lines, the current front lines need to be recognized as at least a starting point for those negotiations. Now, how the Ukrainians feel about that is a different question, and we have seen different voices emerging from the EU as well. The EU Foreign Policy Chief, Chike-Obi, said that Russia should not be rewarded for its aggression with more territory. So that will be a very delicate dance in the lead up to that summit this Friday.
Yeah, and I'm curious now whether or not a deal is actually possible without the blessings of the Ukrainians here, because at some point they will need to come in and, I guess in many ways, rubber stamp what was agreed on.
Yeah, I mean, we saw that Vice President J.D. Vance met with Ukrainian officials in the UK over the weekend, so it does seem like they're involved in these negotiations. There's a question whether President Zelensky will be in Alaska for the summit itself, but certainly there's no deal without Ukraine being involved. There's no truce without Ukraine signing off on anything. So the U.S. President will need to work very hard to bring them on board to whatever he agrees to with President Putin.
All right, fantastic, Balazs. Thank you so much, Balazs Pence. They're setting us up for a very big week as far as geopolitics goes. Coming up on shows, John Woods joins us from Lombard Odier, telling us why they expect U.S. growth to slow and the labor market to soften in the second half, what it means for the Feds as tariffs take effect. Counting down to the open of trade in Shanghai and Shenzhen and here in Hong Kong. Just under 18 minutes away, we're watching lithium and lithium themes very closely. CATL indicated higher this Monday. This is the China Show.
It's looking to be a pretty busy week this week, right? Take a look when it comes to the data front. We talked about the data dump on Friday with China. The U.S. CPI print, that's going to be the next one after what we saw in that jobs report that really kind of turned all these rate cut expectations around. Certainly, whether it kind of justifies the market pricing of maybe 2 rate cuts this year from the Fed, that certainly is going to be one thing. And then we also have an RBA decision on Tuesday. It's almost guaranteed they're going to cut in Australia as well. BOT is going to meet. But then again, we got to really focus on a lot of the earnings picture and that Trump-Putin summit as well this week.
Yeah, which will be indicative really when you look at the outlook for oil, number one, and also the prospects, what that means for a China-U.S.
That's true.
Part of the negotiations there.
Yeah, of course, we're going to talk about that truce, right, between the U.S. and China. That actually ends on the 12th.
Tomorrow.
Yeah, so we got to come down to that as well. So certainly whether that gets rolled over is certainly one thing to watch as well. Let's bring in John Woods, Asia CIO and Head of Investment Solutions at Lombard Odier. It's a big week. What do you focus on the most?
Well, I think the US-China deadline tomorrow, as you pointed out, is super important. My sense is this is essentially a trade-off between rare earths and semiconductors. I don't think either side have quite the upper hand that they may think they do. So I think that, as you point out, they will be rolled over for another 90 days and allow negotiators on both sides really to try and hash out a working deal. My sense is they're somehow connected also inevitably to the talks between Russia and the United States in Alaska as well. All these things essentially tend to be interconnected, particularly around the eventual resolution of tariffs.
The window that's been given, let's use the 90 days in the U.S. and China. That seems to be a point where, hopefully, if Donald Trump gets what he wants, the end of the tariff conversation, and hopefully the end of several wars. What does the outlook for equities going into that window look like?
Well, equities right now are pretty much trading at or close to all-time highs, aren't they? If you look at Europe, if you look at Japan, if you look at the US, there seems to be a substantial amount of optimism and good news baked into those prices. When we get to these sort of extremely elevated levels, obviously the focus then turns to valuations. People start worrying and focusing on which market is the most expensive and which subsequently is likely most to correct. I think one of the positives we've seen in the last 6 to 9 months is the degree of rotation from the US to other markets. In my mind, this is broadening the equity offering. At Lombard Odier, we are a little less focused on developed market equities, which we think are extremely expensive. Again, possibly a function more of multiples and earnings, and tilting our attention much more now to emerging markets, where we think more value lies and where we also see the liquidity rotating into. So that's an area of focus right now that we think offers value.
And when you add those ingredients, I think China markets is the answer in some ways, right? When you have liquidity, you also have a bit more of the southbound flows and the like. And, you know, the IPO market is hot in Hong Kong, so certainly that's helping things. And then you have also these resilient markets in the face of tariffs. But you're not quite convinced yet to kind of go
again,
forward.
I would extend that observation around multiples and earnings to China as well. I think it's more of a multiple story than earnings. Earnings, I think, are likely to come into the high single digits for this quarter. So it's not really going to set the world on fire. At the same time, we saw PEs last year around 10 times. They've ticked up higher now to around 14 and a half times. So the market is beginning to look expensive. I would position China more as a diversifier than an outright overweight. And that's certainly the way that we look at it as part of the emerging market complex, rather than a standalone market in itself.
What would be the overweight within EMs if it's not China?
Actually, we do have a preference for India. We do think the Indian market has a degree of insulation and protection from global volatilities that interest us.
Well, that's what we thought until last week, until they became the target of Donald Trump's
and
hearts.
one of the worst in terms of getting a deal.
Again, I think the India story is possibly tied up with the Russia US talks as well. Again, I believe all these subjects are somewhat interconnected, and if we were to get some sort of if the direction of travel was towards a resolution with Russia, I think the pressure on India might actually diminish somewhat. But sorry, to come back to your point, I think that South Korea, Taiwan, India have frankly more upside than the China story right here, right now.
Okay, you're still expecting growth, though, in the U.S. to slow down. Is it going to justify what the market's pricing in, that the Fed's going to have to start cutting at least 2 times this week? I mean, this inflation print this week, this year, I should say, but the inflation print this week is probably going to be quite significant.
Yeah. Our view has always been that the labour market in the United States is perhaps not as robust as the market was originally anticipating, and that, I think, was underscored by the job numbers that we saw published recently. Our view has remained unchanged. I think the Fed will actually cut 3 times, not 2 times, this year, with the first cut in September. Again, I think the Fed will look through any short-term spike in inflation caused by tariffs, because I think their underlying focus has to be on the health and quality of the labour market, which in our view is perhaps a little less robust and strong as the market might anticipate.
That's a cut at every remaining meeting, if I'm not mistaken.
Correct.
Out of the Fed. Might that change the market's view on the U.S. markets? Might that be the new driver of U.S. economy markets if earnings are narrowing?
Coming back.
Well, if you can completely distinguish between markets and the economy, then yes, I think it's probably good news. But the Fed, in my mind, will be cutting because precisely we are seeing deceleration in growth, not a recession. The base case is not a recession; it's for a slowdown. I think that's an important point to make. But nevertheless, when you start to see unemployment ticking a little higher and jobs creation beginning to be a bit more sluggish, there's an underlying consumption consumption and demand story there that needs to be focused on. But overall, I think it's probably dollar negative, actually.
Okay.
And I think that in turn that becomes a little more emerging market positive.
That's right.
So that's another reason why we tend to have this focus on the EM space.
You're also neutral gold. I want to ask you why. Is it just things have gone too far?
Yes, gold had something of a vertiginous, parabolic rise in price, didn't it? And it's almost inevitable that you will see a period of consolidation, which, by the way, is what I think we're seeing now. Obviously, there's a huge amount of geopolitical uncertainty, and that tends to benefit the price of gold. But in our mind, frankly, there were other opportunities. There were more, from an asset allocation perspective, there were other opportunities, meaning take profit on the gold position that we'd held for 2 years and allocate into more profitable areas.
Okay, we will have more with John Woods in a couple of minutes, Asia CIO, their head of investment solutions, Asia at Lombard. Odier, we're looking at CATL very much in focus, given all the massive news still coming out of the company, the lithium mine and the stoppage there, which the company, by the way, says will not have material impact on operations. But as you can see, though, the rest of the lithium complex, not just in China, but across the region, we're looking at gains in this order of about 11, 15, in some cases even more when you look at some of the names in Australia. We'll have more on the story coming up. The opening bell under 7 minutes away futures are doing this. I'll leave you with a look at that, and we'll get you a fuller preview on the other side of this break. This is the China Show. Good morning.
If you're long lithium, this is certainly your day. Take a look when it comes to CATL and the like here. This is on the back of them confirming our Bloomberg scoop that they suspended production at that mine. So you are seeing the likes of Tianqi Lithium, Ganfang Lithium are surging double digits here this morning. We're up some 15% for Tianqi. You take a look at the rest of the lithium space in Asia that's also lit, as Dave has talked about here. China Renaissance, that's also one story. It continues on to extend those gains after what we heard from BofA, the former chairman and founder of the firm, was released from detention, according to our sources there.
Yeah, so that stock already on Friday saw some massive upside. We are extending that today. Going into the market open, the cash market, Hang Seng Index, Hang Seng China, Hang Seng Tech, where we are entering a big earnings week. You have Tencent coming out along with some other index heavyweights, so keep an eye on that. We'll talk more about these revisions we're seeing underneath the hood in a moment with our folks at Bloomberg Intelligence. Now, all things equal, nothing much to note as far as the fix was concerned. That's point number one. Point number two is, in case you missed that, the inflation print, which came out on Saturday, not as bad as compared to estimates, at least on CPI, although on PPI we did see an extension of the streak of monthly declines. The open is next. This is Bloomberg. Good morning. Welcome to the show. Counting down to the open of trade here, 40 seconds away. Just a reminder that Japan is shut for Mountain Day, so that's a big chunk of volume that's going to be offline today. No cash treasuries as well. Treasury futures, last we checked, were on the way up, so yields are pushing lower ahead of U.S. CPI coming out tomorrow.
Yeah, that certainly is the big one to watch on the macro front here, and what this means when it comes to, of course, the Fed direction, and really after that weak labor data that we got just a few weeks ago, certainly there is signs of Fed cut expectations are certainly changing here every day now. You take a look when it comes to China markets, though, it's a pivotal week, right? You take a look at when it comes to earnings, likes of the big tech, also when it comes to big data as well. We got the data dump on the end of the week. So there is a lot hanging here on equity markets here in general. Today it is a lithium story, which we'll get to about a little bit on CATL. But there you go. Their open is looking like this in Shanghai. We're slightly to the upside here in the CSI 300 as well. We're watching very closely CATL shares. The A-share market, the A-shares are not doing anything right now. But what we're watching very closely is lithium futures. What we're hearing, the Guangzhou contracts, from according to some traders, surged by about 8% or more. And we're seeing lithium stocks around the region basically rallying on the back of this news, the CATL confirming that they have shut production in one of those mines. This is the mine that basically makes 30% of the world's mine production. So certainly that's why it has huge implications for the lithium markets there. But yes, is this the next sort of target of anti-involution is a key story and key question here today. Yields are slightly to the upside, sort of, in bonds, given this whole anti-involution and the like here. We have seen yields actually melt up in China the last couple of weeks or so. You're watching the Hong Kong Open, and things are looking a little bit better, right? We're up about 0.4%. HS Tech is catching a slight bid. We're watching the likes of Alibaba. That's seeing gains about 1%. Meituan's heading the opposite direction here today. But really, what we're watching very closely is what the tech sector brings, right? Given what we saw in terms of the earnings and the side of things, what really we could expect here. We're going to get Marvin Chen from BI to talk us through about the Tech 8 to really watch out for here. Take a look when it comes to lithium miners, right? Because that's the one to watch. So CATL confirming our Bloomberg scoop about this. What this means for the lithium price. I mean, the likes of Citi, I'm reading some reports saying that it could rally to above 80,000 yuan a ton in the next couple of days or so. That, certainly that is why we're seeing some of these lithium miners are surging on the back of that. These are some of the onshore ones that have just opened up. So Tianjin Lithium A shares are up some 6%. I think we're seeing much more price action in the 8 shares here right now. There you go. 8 shares of CATL have just opened, and they are up some 2%. We're also watching some of these chip makers, some China car makers as well, as some keys to focus here. Of course, Nvidia, AMD agreeing to pay about 15% of their China chip sales revenue to the U.S. You are seeing some of these chip names in China falling on the back of that. Might not be related, but we'll see. But, car makers is one thing. So CATL obviously is one story, but also car sales slow as we start to see this sort of anti-price war starting to hurt demand.
Yeah, that's interesting on the Nvidia story. The tax of doing business with China, I guess, is just something you could call that. For some final thoughts, still with us, John Woods, Asia CIO, Head of Investment Solutions at Lombard. Odier, Yvonne just ended there by talking about these efforts to end the deflation or price wars, or trying to get people to incentivizing companies to stop cutting prices. Is that a macro story, or is that a sector story when it comes to China?
When it comes to China, I think both. It's a profoundly important growth story. Whereby consumption clearly is the missing leg of the stool when it comes to broad-based growth, and that's clearly an area that the authorities are keen to target. The story around China right now is very much one of export-driven growth, as we all know, and to an extent government-led investment. And consumption has been somewhat unique in its lack of support. So, yeah, I mean, everything and anything that the authorities can do now to really encourage consumers to start opening the purse strings and start spending is of critical importance. And, where you do have this race to the bottom in terms of pricing and industrial profits, by the way, it does have an impact on deflation and disinflation, and that's really the real concern underlying this whole story. China does not want to get into a disinflation trap right now. Some would say on the PPI it already is to an extent. It is on the CPI. They have to get themselves out of it sooner rather than later, and I think the involution program is part and parcel of that.
What will it take, though, to absorb that excess capacity? Because this is coming at a time when, yes, the first half of growth in China was quite resilient. The second half, people are questioning whether exports can actually hold up.
Yeah,
and maybe things might start to slow down.
There's no magic bullet. There genuinely isn't. People are looking to fiscal stimulus, monetary easing, government levers to try and promote consumption. It's really about the appetite and confidence of consumers to spend. And to try and turn around that right now is a very difficult story. So if you look at growth forecasts for China, I mean, the direction of travel is a modest decline to a degree of stability. But to try and turn around depressed consumer sentiment, as we found out all around the world, is a very difficult one.
And, the analogy to or the connection at least to the macroeconomy is, this has come up in the last few weeks, that the economy is not doing bad enough that it needs urgent stimulus, but it's not doing good enough that the earnings story is compelling. And I wonder how you look at that from an earnings revision perspective. Are you worried? Is it compelling? What does that tell you about what investors are buying into when you look at the equity market?
It's what I might call a Smith story. I mean, it's not particularly exciting. It's not particularly worrying. It's somewhat of an average earnings outlook that is not really going to, in my mind anyway, set investors afire with optimism and enthusiasm. We'll hear more from your colleague on earnings, but we're looking at sort of high single digits for the major sectors. And in my mind, that is not sufficient really to start reversing capital flows away from other emerging market competitors into China. Again, this is, I think, a story more about multiples and expansion than underlying earnings. And, as I say, in my mind, that makes China a diversifier rather than an outright overweight. And that's essentially how we're positioning the market within our own tactical asset allocation.
You still prefer tech and consumer names. Can you flesh out that call a bit more?
Well, I think tech will continue to drive the China story for quite some time, given the underlying R&D, given the political focus as well on trying to create a degree of self-sufficiency in that space. I think it's got decades to run, frankly, as a secular growth story. And again, if we can cherry-pick certain consumption and consumer plays in China, given the focus that we've just discussed, I think there's upside there as well. But it's all about cherry-picking. There are diamonds in the rough. There are absolute opportunities. I think the directional play is yesterday's story, metaphorically. And now it's down to analysts with a bottom-up focus looking to identify value. And that's where I think the opportunities lie.
Okay. Now we have to identify those analysts. John Woods, Asia CIO, Head of Investment Solutions there for Asia at Lombard. Odier, thank you so much for setting us up for this week. Right. Speaking of that, we'll kick things off with that last point that we were just making there as far as earnings go. So a big week this week. Tencent, JD, Alibaba, among the many others. As you can see, the big names reporting this week. You have hardware makers as well, Lenovo, and some car makers like Geely are set to report later in the next few days or so. Right. Now, that gets us into this note, which came out late last week out of Bloomberg Intelligence. So they think that sentiment for China's tech stocks might actually be turning among mainland Chinese investors before, of course, this earnings season really gets thick and heavy.
Yep, and since April's tariff announcement, sectors like healthcare, new consumption had drawn investor attention. Yeah, that's Labubu's, right? Which could be now shifting back to tech. Our equity strategist there, Marvin Chen, is the author of that report and joins us now. So yes, maybe a switch back to big tech. Tell us a bit more of the earnings on deck and seeing some momentum in Chinese tech. What is really driving that momentum right now?
Yeah, so over the past 3 or 4 months, China tech has really kind of taken a back seat in the post-Liberation Day rally. But more recently, since the middle of July, we've seen some rotation back into tech. Flows over the southbound stock connect into the big tech names have bottomed out towards the end of July. And we think some of this may be driven by expectations on earnings or the hope that, China tech can sustain the market sentiment similar to what we've seen, in the U.S. and the Mag 7. So, earnings over the next week or two will be key to sustaining the momentum, particularly given, Chinese stocks and indices are at multi-year highs and valuations are, have normalized.
Yeah, that's an interesting juxtaposition because in the U.S., just a handful of names were enough. To lift the benchmark. Can we make the same, I wouldn't say conclusion, but can we make the same assumption that that's going to be the dynamic when you look at the Chinese market?
Yeah, I think for the second quarter, it's still going to be quite challenging for tech. I mean, we have some of the rolling off of the stimulus from last year and also the fading of the consumption trade-in programs. We also have tariffs, but that's more of an export-oriented story. I think for China tech, the main concern is the price wars that, we've been discussing. So, on one hand, we do have renewed AI enthusiasm, but remember, a lot of the China tech giants are also e-commerce and delivery platforms that have been exposed to this involution. And, policymakers, have been talking up supply side reform, anti-involution, but, these things will take time.
Yeah, when can we see that impact is a big question. And how should investors position for that theme?
Yeah, so the last time China embarked on supply-side reform, 2015, it took about 6 to 12 months to lift producer prices out of deflation and increase the industrial profitability. Policy at the time was a key catalyst for kind of sustained momentum within the A-share market between 2016 and 18. So we think this time around, A-shares do have some tailwinds going into the second half of the year because the A-share indices are much more exposed to materials, industrials, and some of the sectors such as the EV supply chain, which stand to benefit from these reforms.
Marvin, thank you so much. Marvin Chen there out of Bloomberg Intelligence. A fantastic curtain raiser going into this earnings. Big earnings week. Flows are coming through. That is a good indication of preference from mainland investors. Coming up, Goldman Sachs joins us for their latest outlook on the economy there. We'll unpack the 3 things on China. Fantastic note that comes out every Sunday out of Hui Shan and her team there. Everything from exports beating the conversations around the lack of inflation so far, plus many other things we'll talk about with Goldman Sachs at those times on your screen. Suffice to say, much more ahead. This is The China Show.
Here are some of the stories that we're tracking for you this morning. Treasury Secretary Scott Bessent has told Nikkei News the U.S. aims to finish trade negotiations with remaining partners by October. Canada, Mexico, and Switzerland are still seeking better terms after Trump's new tariffs took effect. Bessent also reaffirmed the importance of the Fed's independence, but told Nikkei the next Fed chief should be forward-thinking. The WTO is predicting subdued global merchandise trade this year and next, saying activity remains clouded by President Trump's tariffs. But it lifted its estimate for trade growth this year to 0.9%. That's compared with an April forecast for a 0.2% decline. That's due to U.S. importers rushing to stockpile products, parts, and raw materials before Trump's higher levies hit.
Okay, let's turn our attention back to China here. Chinese authorities have reportedly detained a senior diplomat who heads the Communist Party's international department. The Wall Street Journal says Liu Jianchao was taken in for questioning last month after an overseas trip. Let's bring in John Liu, our senior executive editor in Beijing, for us to talk us through what we know so far about this. And effectively, John, what do we know about why Liu was detained?
Well, we don't know very much at this moment, David. What we have is that Wall Street Journal report that you mentioned saying that Liu Jianchao was taken into custody for questioning at the end of July after returning from an overseas trip. We have not had any official commentary from the Foreign Ministry, from the International Department of the Communist Party, which Mr. Liu led, nor from any other government agency or state-owned news outlet. If you'll recall, the former Foreign Minister Qin Gang, when he was removed, it was several weeks before we actually got word from the government about what had happened. And in that interlude, there was just a lot of events that we would have expected the foreign minister to appear at, in which he was absent. And so I think we might be in for a period of prolonged sort of uncertainty going forward until we find out ultimately what has happened with Mr. Liu.
How prominent of a figure is he, this Liu, John? Because you mentioned he heads the international department. In terms of where he stands in the ranks, where is he?
He is, I would say, the second most senior diplomat in the Chinese system, or at least he was before he was taken reportedly into custody for questioning. As head of the international department, he would have been in charge of China's relationship with other communist countries, North Korea, for example, Vietnam, and also liaising with other political parties. Mr. Liu was actually in the United States. He visited New York and Washington in 2024. That was seen as a very important trip to try to stabilize the relationship between these two countries heading into the election at the end of 2024. And a lot of people, he was widely seen as being a candidate to become the next foreign minister for China. And so if something has happened with Mr. Liu, this would inject a lot more uncertainty, not only into the relationship between the United States and China, but just the general diplomatic policymaking here in China.
John, on a separate story that's also garnering a lot of attention here, China Renaissance and the founder there, Bao Fan, and some reports that he has been released and it is no longer under investigation. What do we know about that specifically?
So what we know is on Friday, we found out that Mr. Baofan had been released. He'd been in custody for the better part of 2 years. He was taken into custody in 2023. He resigned as chief executive and chairman of China Renaissance, the firm he founded, in early 2024. We still do not have details about under what circumstances he was taken into custody, what investigation was being conducted, why he was part of that investigation. We do not know. All we have so far is a comment from China Renaissance saying that he is no longer part of the day-to-day management of the firm, and so they are not going to comment on his personal affairs. His wife, Mr. Baofan's wife, is currently the chairwoman of China Renaissance, and over the last 2 years while he's been in custody, that firm has suffered greatly. It's lost a lot of talent. It's seen losses, its revenue go down, and you've seen the stock jump on Friday, and I think it's up again today. I think there's an expectation that maybe with this overhang removed, there's an opportunity for this company to get back to doing business.
Yeah, maybe that's why the stock has been up and continues to be here this morning. John, thank you. Our senior executive editor, John Liu, joining us out of Beijing. We got plenty more ahead. This is Bloomberg. Some big corporate stories we're tracking for you today. Palantir Technologies is now the most expensive stock in the S&P 500, forcing bullish investors to bank on increasingly robust future growth to justify its price. The stock has soared, get this, 2,500% since 2021 and closed at a fresh high on Friday. The stock now trades at 245 times forward earnings. Palantir has been boosted by growing AI use, its business ties to the U.S. government, and stellar earnings. The Wall Street Journal says Intel CEO Lip-Bu Tan is set to visit the White House on Monday after President Trump called for his removal over ties to Chinese businesses. The report cites sources saying Tan hopes to show his commitment to the U.S. and propose ways the government and Intel could work together. Trump posted on social media last week that Tan should resign immediately over conflicts of interest. BHP Group says it will lead a consortium of steelmakers and industrial giants investigating carbon capture opportunities across Asia. The world's biggest miners said its study partners will include ArcelorMittal, Nippon Steel India, JSW Steel, Hyundai, Chevron, and Mitsui. They want to identify potential large-scale projects to store the emissions used to turn iron into steel.
Okay, yeah, that's interesting story. Okay, couple of things as we make our way into the thick of Monday. So one is, we talked about this with John Woods earlier on, right? And also Marvin Chen out of our Bloomberg Intelligence team. The market has not rallied straight up, Greater China, but it's rallied enough that the theme and the trend has been clear, right? Higher and higher lows. Weekly chart, MSCI China, we showed you this a couple of weeks back. We are still at about that key level, and we're getting the big earnings coming through this week, and of course key constituents, of MSCI China, and whether or not that will be enough to result in a melt up in multiples. Let's see what happens with that. But yes, something to watch and a key level to watch. Let's call it 79.24 on the benchmark itself, and we're slightly above that level as we speak, 79.56. The other key theme is we're coming out of the weekend. We had industrial China PPI coming out, and that goes into the anti-involution conversation and whether or not that is able to lift profits on the industrial side of things. Again, very brief history lesson. We're on fave. Okay, you know what? We will leave that here for now. I think we've got on the charts. But why not? If we had to pick an alternative, why not pick your fave, right? Anyway, we'll look at that a bit later on. But yeah,
it's coming.
Lithium stocks are fairly lit. Thank you so much. We'll do this later. Come on, we gave it away already. We'll do this later. Yvonne.
Technical stuff.
Yes. Yeah.
We're live TV, right?
Yeah. Manual error, rather. But yes.
Okay. Lithium stocks, though. Let's get that one ready to go. That certainly continues to be surging here this morning after what we heard CATL pausing output at that mine. We got Matty Zhao from Bank of America. Going to be talking a little bit more about this. They sort of were anticipating this, right? There was so much interest in this leading up to this announcement that they were actually flying drones around just to see if they were trying to gauge what was going on.
With the permit.
Yeah, before the permit actually expired. So the fact that now it's been confirmed, what does that leave the lithium price? If you're talking about now potentially here the cut of production, we're also entering into the EV peak season. So Matty Zhao from Bank of America is going to talk about that. She thinks maybe 80,000 renminbi in the near term for lithium prices could be on the horizon there. CATL 8 shares are up, but then take a look at Tianqi Lithium, it's up double digits here this morning. CGBs, you've been talking about that story, right?
Yeah, so I think we're noticing a pickup in the yields right now, something that is not as pronounced. Now, suffice to say, I guess more context, right? 1.1 basis points is not really a big one. But all that said, we're coming off a low 160s, and this is something we don't normally see for this time of the day. Might this be down to lithium? Might this be down to inflation conversations? But yes, we are seeing a bit of a pickup, and I guess slight steepening in the curve with the 30-year now closing in on the 2% handle. There's that, and of course there's the oil story, which really is at the very center of all the geopolitical themes we're tracking this morning.
Right, because when you talk about we're extending the losses after the biggest weekly decline since end of June for oil prices, right? So this, a lot of it had to do with OPEC Plus boosting production, but now when you add this whole kind of Alaska, Trump, Putin sort of talk and the prospect of maybe of the end of the Ukraine war and maybe even more supply into this market, where does that leave oil prices there? But yes, we got much more coming up. This is Bloomberg. Welcome back to the China Show. Hope you had a great weekend here. Second hour is looking like this. It's a bit gloomy here in Hong Kong, and you're seeing when it comes to the Hang Seng, though, still things are looking, pretty slow. It's still a bit of the summer sort of doldrums here today, but 8 shares are slightly a little bit doing worse. We're down about 1/5 of 1%, but it's a pivotal week, as we talk about, right?
Yeah, because you're back.
And I was gone for a whole week.
And you mentioned that this is actually quite gloomy.
Was it really bad?
Well, I was about to say, you just escaping us for a few days, and then you calling this gloomy. This is glorious. This is a 9 out of 10.
4 black rains in a few, how many days? I was reading something on social media.
I forgot how the sun looked like. Let's put it that way.
No.
After the success.
Well, I'm glad that you guys are getting some vitamin D in, or some.
Yes. Yeah.
But you take a look at these markets. We talk about how, it's an interesting week, right? We talk about earnings. You have the likes of the big tech in China that are reporting later on today. You also have the data dump at the end of the week as well. So there's a lot really kind of event risk there. And the inflation numbers really was a telling sign of just, things are not really looking that great in terms of the whole inflation side of things, despite all this talk about anti-involution, right?
Yeah, well, it circles this conversation precisely back there, right?
Yeah.
So when you look at PPI, for example, again, dropped more than forecast, and CPI was okay, but when you look at, say, food, alcohol, and tobacco, which is one category, I'm not nitpicking, of course, those three.
Not in your dietary.
No, that's not like my nutrition needs for the day. That actually fell much more than expected.
Yes.
Well, I say much more than expected. It was a standout to the downside, that product category. So it really underscores to the point you were just making here of this incentives to incentivize companies not to cut prices even further.
Yes, and so there's certainly that. And then on top of that, keep in mind, it's August 12th tomorrow, right? That's when, we start the countdown to, of course, when this trade truce between the U.S. and China expires. Yeah. It seems like the narrative in this market is that, people are expecting it to roll over and that we're going to get maybe another more can kicking for another 90 days. But we haven't heard otherwise. But then again, you're seeing a lot of evidence of the U.S. side of things that they're really trying to actually smooth out a potential trade deal with China or a meeting between Trump and Xi. This Nvidia line recently is pretty interesting as well, how they have to pay a portion of their revenue to the U.S. government.
15%.
Yeah.
Them and AMD. which just goes into some of the gives that the U.S. then went in to be able to get China back to the table,
Yes.
at least pave the way for a deal, which I think Scott Bessent now says is looking perhaps likely for the end of October, I believe, of course, in time again for any potential meeting at APEC, which I believe is about in November from now. Okay, that's one key theme right now that when you look at these markets, one sort of sector stands out. Particularly across the equity complex is really lithium and lithium-related stocks. So whether that's some of these big names in Australia and some the names that have come online here in Hong Kong and in mainland China. So you have CATL, of course, up 2%, but it's really the peers on your screens up 20%. Tianqi and Gangfeng are up in the order of magnitudes of this sort. The big story was CATL suspending activity at a major mine, no license there, spurring hopes of wider output curbs. Let's bring in Matty Zhao, co-head of China Equity Research and head of APAC Basic Materials Oil and Gas Research at BofA Global Research. So 2 weeks ago, you were here on set, and you told us specifically August 9. That's the date to watch. You called it. What do we do now?
Yeah, so actually over the weekend, you said that the CATL's license was not renewed, and we hear that probably at least for the next 3 months that they will have to suspend this. And CATL actually is about, this mine is about 6% of global lithium supply. So it's very meaningful for that. And because currently that the overall oversupply of the market year to date is only 2%. So taking away 6% actually means that we are going into a deficit market in the next few months before CATL come back, or if they can come back. Also, we are heading into a peak season for EV. Normally, in the next 3 months, we should see lithium demand to go up by 5% per month, at least for the next 3 months. So we're basically running down the inventory for the next 3 months during CATL suspension. I think it will means that the lithium prices in the near term has very big upsides. We actually see future market limit up already this morning. Yeah. Also, if you look at lithium prices, it came down all the way from 600,000 to now 70 to 80,000, right? So a 10% up doesn't mean that it's already capturing all the upsides from a surplus market to now a deficit market. Not to say that apart from CATL, another 7 mines in Jiangxi, which is another 5 to 6% of the supply globally, are at risk because they're having a similar issue versus CATL's mine as a kaolin mine. So as a start, they are not a lithium mine on the license. So currently, under this anti-involution that government have been pushing, Jiangxi government issue a regulation basically on the 14th of July, asking all these 7 mines to submit document by the end of September. So the next day to apart from whether CATL can resume, is 30th of September. If all these 7 mines cannot submit enough document to satisfy the government to say that they meet the criteria of lithium mining instead of kaolin mining, then you should be expecting another 5% cut on the supply in the long run.
You mentioned, are you seeing this case as the next target of anti-involution? Is this their way of curbing overcapacity now?
I think this is one of the sectors. Well, obviously, lithium is not the key sector. It's a relatively smaller sector compared to cement, steel, etc. But what I'm saying is, under this anti-involution as a whole, I don't think local government is there just to give you a license without enough, meeting enough, regulations and stuff like that. So they will be probably tighter in terms of scrutinizing all these criteria as well. That's why as long as in these sectors, in certain sectors, if you are not meeting the legal criteria, I think there is highly likelihood of closing.
Yeah, they'll choose to look at it more closely, let's put it that way. So what's the potential? You said substantial upside in lithium short term. We're now at 10% of the peak. What is substantial upside?
Well, I think for lithium prices in the short term, if it rebound from 70,000 to 100,000, I wouldn't be surprised, or even higher than that if the other 7 mines are closing. I think it would be even higher than that as well. Like I said, lithium price come down all the way from 600,000 to now. You're only 12% of the peak, right? So if it's up, to 100, 120,000 in the near term, I wouldn't be surprised.
What does it mean for battery prices? And further upstream, if battery prices are going to adjust, what does it mean for margins of the automakers? Will they then need to adjust? Like, is controlling the upstream in some ways influencing the final product price?
Yeah, sure. If this lithium prices rebound is more sustained than like a short 2 or 3 months, we should see battery prices to follow as well. Of course, depending on the magnitude of the lithium prices going up. Right. If it's only up from 70,000, say, to 80,000, then battery price not necessarily need to go up that much, right? But if you look at, in the past when lithium was above 300,000, battery prices was also adjusted every time when lithium prices go up as well. Also, it will probably affect in the short term some of the battery maker margin as well. Again, if you look at CATL, when the prices were 300,000, when they go up very fast in 1 quarter, their margin actually dropped to, I think, low to mid-teen compared to normal 20 to 25%, because you need time to catch up for the short term as well. But then if going into the auto sides, it also probably means some margin pressure for the auto, depending on whether the auto can pass on the prices as well.
Matty, thank you so much for coming in. We had to call her like last hour to come in, and she
What are
came
you doing
in,
this morning?
Yeah, like now.
Thank you.
Thank you, Matty Zhao. There, going up China Equity Research and head of APAC Basic Materials, Oil and Gas Research at BofA Global Research. We're going to talk more about that, more about anti-involution as well. Coming up next, Goldman Sachs joining us to discuss the inflation outlook in China amid, of course, this crackdown on excessive price discounting. This is Bloomberg. All right, we're talking all things lithium, and now we're going to talk about this whole bigger theme of what this all means, right? This drive from Beijing against excessive competition may be key in easing deflationary pressures. Our China correspondent Min Lo has more on this so-called anti-involution campaign and what it's designed to achieve.
It's vouchers galore on China's food delivery platforms, intense promotions leaving customers spoiled for choice, milk tea going practically free.
I drank 4 to 5 cups of milk tea in a day. The vouchers for first-time buyers are too good. It's a waste not to use them. But I overused them and drank until I ended up in the hospital.
The race to the bottom has become a national obsession and a policy problem. In July, China's Politburo vowed to curb what it calls irrational price competition, the directive coming right from the very top. President Xi himself calling for an end to involution, or 内卷 in Chinese, literally meaning rolling inwards, a phenomenon where vicious competition leads to diminishing returns. It was used back in 2020 to describe mindless workplace competition. Now it's permeating sectors from electric vehicles to e-commerce. In June, officials summoned the heads of BYD and other major EV makers, warning them to self-regulate after BYD launched a new price war with discounts as steep as 34%. In July, food delivery giants were summoned after JD.com started a price war with its entry into a space once dominated by Meituan and Ele.me. The anti-involution campaign comes as cutthroat competition has squeezed industrial profits. Factory deflation has lasted 34 months, while the consumer price index hovers around zero. The need to reflate the economy and expand domestic consumption increasingly urgent under the threat of more tariffs. But China has done this before. A decade ago, capacity cuts in steel and coal sectors helped end a 54-month stretch of factory deflation. But this time, the job is much harder. The most severe price wars are dominated by private firms.
Managing private companies to stop them from over-competing against each other is a much more tough job and much different task compared to control SOEs to cut capacity.
Anti-involution will not work in the next probably 4 to 8 months, but over time, the capital market will pick up the positive sentiment, and in a year or two, the real economy will respond. So I'm fairly positive over the impact of this in the long run.
As China charts its priorities for the next 5 years in the upcoming October plenum, Xi faces a challenge: how to coax CEOs to cut production, consumers to accept higher prices, and local officials not to compete for new investments crowding into the same sectors. Analysts say any supply-side reforms will likely be gradual to avoid job losses and painful repercussions for the economy. Min Lo, Bloomberg News, Hong Kong.
It is, and I think the data points on the weekend is a reminder really of the need for not just supply but also demand side. In fact, Goldman Sachs put up a report right after the inflation numbers came out, and while it's part of the PPI deflation may be pointed to transitory factors, you have weather conditions, what have you, we believe, change the page please, that without broad-based demand stimulus, the current anti-involution policies are likely to deliver a rapid PPI reflation in China. Joining us now is the author, one of the authors of that report, Hui Shan, Chief China Economist at Goldman Sachs. Nice to see you.
Nice to be here.
What's the initial prognosis looking at the inflation numbers? Why is there a lack of it?
It's too soon to tell. The anti-involution stepping up that narrative and that campaign really happened in July, and you start to see futures prices going up. But if you look at the spot prices of coal steel, they didn't go up as much as the futures prices. So this PPI is measuring spot prices. So in a way, people are anticipating some impact, but July is just too soon to tell.
How do you see this all playing out? We're starting to see a little bit of maybe curbing outputs in certain subsectors of the commodity side of things. But in terms of what it means for overall the jobs sort of picture, and even in terms of consolidation, right? I mean, how is it going to hurt growth in some ways in the short term?
Yeah. Put it very simply, this is a bit of a contractionary policy from an output point of view. Whether you cut capacity, whether you cut production, from a GDP point of view, that's a negative. We can argue how negative that is a marginal, directionally we think is negative. Now, the complexity is how you deal with it. You mentioned labor market. That's certainly one potential constraint. And what about financial market? We're still dealing with bad loans coming out of a housing downturn. So if you have manufacturing loans being written off, can the financial system shoulder them all at once? That's another constraint. And then I was listening to the video clip, right? We're talking about food delivery, we're talking about EV, solar panel, talking about coal, steel, cement. So it's a varieties of industries. It's very hard to come up with one solution. The food delivery solution probably doesn't apply to the steel and coal. Sure. So altogether, I think that's why, before the program, I was saying this is uncharted territory. I don't know how exactly this is going to play out, but we do think that we need to take this seriously, but this is coming from the very top. We also need to acknowledge the difficulties in tackling this problem.
So at the moment, so you have CPI and PPI, two data sets. What do you think is slightly more important than the other right now, based on the current market narrative?
Yeah. For investors, I think people are watching PPI because that tend to be where you think about China's overcapacity in many industries. You think about sort of the deflationary impulse, which one is driving it more. I think a PPI is something you need to watch out more closely. CPI is important for consumers, but it has administrative price controls, whether it's medical care or education. There are government control prices in it. So for a more timely measure of a turning point, the PPI is more important to watch.
In terms of the data moving forward, what should I be more concerned about as a bigger risk to the economy? Export slowdown or persistent deflation?
I think is a persistent pressure on prices, on labor market, on property market, the domestic complex. How do we turn that from the current very sluggish situation to a more virtuous cycle? That's the key. Unfortunately, the stronger the exports are, the less urgency government may feel to stimulate the domestic economy. So we might stuck in this very bifurcated economy for a while.
I think the phrase you guys used was reactive, I believe, in terms of the policy. Do you think that will remain the case? Policy will be reactive and measured?
I think from a cyclical policy making, macroeconomy, it will be reactive, right? If we had the U.S.-China tariff escalation in April, we had a triple R interest rate cut in May. So that kind of a reactive dynamic we think is likely to continue. But we are seeing more sort of proactive policies on the longer term horizon. For example, the child care subsidy, thinking about subsidizing disabled elderly care. We're talking about free preschool. Those are kind of planning. I think this is in the context of the 15th five-year plan, the government is inching in that direction as well.
Okay, so maybe a little bit on that front. You mentioned about the export numbers.
Yeah.
Is there going to be a lot of payback? What's the aftershock going to look like after the sort of front loading, which really has kept the data pretty strong for the first half?
Right. Front loading is something we have a lot of discussion with clients, but I think there is a caveat here. If you look at the Chinese exports to the U.S., not a whole lot of front loading. You look at last Q4 and this Q1, maybe a tiny bit, but if you look at European exports to the U.S., there's a huge jump. So what we worry about the payback, it's not necessarily direct payback, rather it's indirect payback that other countries were trying to get ahead of tariffs. To the extent that Chinese inputs were used in making those products from Europe to U.S., we could see some indirect payback. But I think it is important to recognize just how competitive, the fact that we're having conversation about anti-involution. Yeah. Chinese products are so competitive on the global stage. And that is just very difficult. Just putting yourself in the shoes of a purchase manager, right? When you see Chinese products versus other products, similar quality, 30% discount, which one are you going to buy? This is a key reason why exports could continue surprise to the upside.
Will it take up a bigger portion of growth this year? GDP, exports to GDP, contribution to GDP.
Yeah, we have been tracking that, and export contribution to GDP last year was more than half of the 5% growth. Yeah. And we're on track for a similar, slightly lower, but similar significant contribution to GDP growth this year as well.
You mentioned front loading to Europe. I'm just wondering, has there been a lot in the EM side too? Is it enough to absorb maybe the slowdown in exports to the U.S. from China?
I think of it as a trade. You think of it as a water, right? It's going to flow somewhere. So there are two variables you want to watch. One is demand. If there's a global demand, whether it's the U.S., whether it's ASEAN, whether it's Europe, if there's a demand, there will be supply. And two is how does the Chinese product compare with the global competitors? If Chinese products continue to be 30-40% cheaper, then it will take a bigger market share. So only watch those two variables, and those, as long as you're not forecasting global recession, I think the Chinese exports are supported.
Okay, what's the outlook? I think just to ask you about activity numbers are out end of this week. High frequency data, what are you seeing as far as consumption trends? That, you know, what's July going to look like effectively?
Yeah, high frequency data domestically are not that encouraging. Property sales down in July, and you talk to restaurants and the service industry. I mean, there are bright spots such as tourism. You go to these tourism sites, the traffic is quite impressive. But if you look at the restaurant services, it's still quite depressed. So we think industrial production is likely to beat because of the exports. Retail sales are going to be better than expected because of distortions coming out of that 6/18 online sales festival. But we think FAI is likely to be a miss. The weather wasn't helpful. Government is not really in a rush to do more infrastructure projects. So it's going to be a mixed bag.
Okay, I'm trying to look, so the longer-term conversations around unlocking structural impediments to growth, let's call it that way, like childcare, for example. How much fiscal space do you think China has to put in place those longer-term fixes?
I think in the next 2-3 years, there should be enough of a fiscal space. Chinese debt is mostly domestically owned. Central government balance sheet relatively clean. And when you're talking about social safety net, it's better to be administered and supported at the national level rather than doing at the local level. So there, I think this is the right thing for the government to do, and there's more space for government to do such policies. Longer term, let's say 5 years down the road, If we have augmented the fiscal deficit double-digit, nominal GDP growing 4 or 5%, you can see that at some point we need some type of resolution, whether it's fiscal consolidation. So much longer term, I think sustainability is an issue. But in the next couple of years that we are thinking about, there's definitely room to do more.
I've got to ask about tariffs. Do you feel like we're getting more clarity on what the trade policy looks like in the U.S.? And do you expect this trade truce with China to roll over?
Yeah. I think with other countries, we had a U.S. deal with the EU, with Japan, with Korea, with a set of trading partners there. There's a removal of uncertainty. We know it's the 15th, it's not going to be 2025. With China, I think the status quo is likely to remain. The reason is that, Chinese rare earth is a real deal, and this is something probably going to prevent trade tensions from escalating. So we're expecting around 30% additional tariff in the second Trump administration to stay for the rest of the year.
Hui Shan, thank you so much for kicking off the week with us. Hui Shan, their chief China economist at Goldman Sachs. We got plenty more ahead. This is Bloomberg. All right, we're taking a look at when it comes to China Renaissance. Okay, those shares have actually reversed here after sources are telling us that the banker, BofA, is no longer under investigation and has left detention. The shares today are down to 8%. They did surge on Friday, though. We're watching the chip space here, of course, on the back of this Nvidia and AMD to pay U.S. for their China sales. So it is impacting negatively some of these Chinese-related chip makers here today, Dave.
Yeah, and we're looking at this trading debut today. Flu shot maker ABNB Biotech as much as 170% at one point. Again, it's the latest in a series of more coming to this market. Plenty more ahead. This is Bloomberg. All right, welcome back. You're watching The China Show. Happy Monday, by the way, if you're just joining us. Okay, so the story across regional markets is, well, number one, Japan is closed for Mountain Day. So you don't have volumes from that side of the Asia Pacific. All things equal, we're up about 0.1%. It's a big earnings week in terms of sector movers. We're mostly to the upside. It does help that some of those sectors are heavily weighted. S&P futures are brushing off, of course, the news coming out of Nvidia and AMD that they have to pay this tax, 15%. In order, let's put it to access the Chinese market. AI is a big part of the conversation this week. You have big tech earnings. A lot of the big movers that we've seen so far in the U.S. In fact, we have a fantastic piece, I think it's on the Bloomberg as well, so everyone talks about the Nvidias of the world. But when you talk about powering the data centers and the AI, right, there are lots of stocks that are connected to that are actually seeing some upside. I guess we can get to all of those themes in a moment there. Apart from that, dollar is slightly to the upside. NASDAQ futures also up 0.5%, Yvonne.
Yeah, I think the ASX is at a record too, right? Thanks to that sort of lithium bid here we're seeing, right? When it comes to lithium stocks, that's really lifting a lot of these names here this morning. But it really kind of, we got to talk about AI, right? As you talk about. When you talk about both China and the U.S. have unveiled their strategies when it comes to AI, the big question is whether it has the sort of power supply to kind of serve and cater to this AI development. Energy consumption has become one of the main focuses as they vie for supremacy in this new technology. Now, the IEA has crunched the numbers, and they're basically saying that U.S. and China have the fastest growing demand for electricity consumption for data centers, and are really accounting for nearly 80% of global expansion this decade. So it brings a lot of questions about the role, Dave, of really green finance. And, of course, when you talk about green finance, there's a lot of questions about what constitutes that as well, right? Because we got to talk about anti-involution. That theme kind of connects to all this as well. This mega dam project as well all kind of goes into that.
Yeah, it does. In fact, when you look at, I think when you look at the projections, right, you extrapolate even further. Our team at NEF, of course, have projected the total U.S. data center power to more than double, right? The market's running with that. What's the next breakout stock apart from Nvidia, right? You answer the question, you probably get that as well. So we're looking at 8.6% of all U.S. electricity demand. Now, that takes us back to the side of the world, right? In China, what does that mean? Big advantage when it comes to energy. In 2024, China added, get this, 357 gigawatts of new renewable capacity and also began the construction, to Yvonne's point, of course, of all these mega projects, almost 100 gigawatts of new coal plants. Now, Beijing has also approved, get this, 10 nuclear reactors, putting it on path to overtake the U.S., Yvonne, as the world's top nuclear energy producer.
So certainly there's a lot of questions about, the significance of all this as well.
Yeah.
There's been a lot of news about this. And really, are Chinese firms really paying attention and really adopting AI and paying attention to the whole ESG factor and all this, particularly when it comes to investment and the responsibilities? That's certainly a key theme. Let's bring in Nneka Chike-Obi, APAC head of ESG ratings and research at Sustainable Fitch here. Nneka, it's really great to have you. So, let's talk a bit more about what we know so far. This sort of revised green finance catalog that China unveiled last month. What do you think is the key takeaways from that, and do you expect it to actually boost green finance in the mainland?
Sure. Good morning. So the revision of the Chinese Green Bond Catalog is a very important piece of work. You've probably heard the term taxonomy, which is what is used in the EU, also Singapore. Hong Kong has a taxonomy. This is the equivalent for mainland China. What they are trying to do is to clearly define the standards and criteria for what is considered to be a green investment. And so tightening and increasing the clarity on that is going to be very important for understanding how to direct capital towards the areas that Beijing thinks are most important for the development of the green economy.
Right. And what about the financing part? How does that evolve alongside now knowing what green financing actually is made up of, for example?
Sure. So at Sustainable Fitch, we work with issuers who want to issue green or sustainable labeled debt. And so it's important for them to have a standard against which they're measuring. So when they're trying to, say, a large conglomerate, trying to identify where are areas in my business where I need to allocate capex towards reducing my carbon footprint, increasing my energy efficiency, they can refer to the China Green Bond Catalog to make sure that what their projects are doing is in line with China's 2030 peak emissions and 2060 net zero emissions targets. We then look at the fact that the issuer has aligned themselves to a reputable standard like the China Green Bond Catalog or a taxonomy in order to evaluate whether or not we believe that bond is actually going to contribute to an environmental benefit and to give transparency to investors.
How does this new catalog stack up to what you see in the EU, for example? I mean, does it actually eliminate some of the loopholes or even greenwashing that we might see?
It definitely introduces more clarity. The EU taxonomy is a lot more focused on very specific technical standards, so they're extremely clear on the exact amount of emissions generated per kilowatt hour for power production, whereas the Chinese Green Bond Catalog, even in its updated version, is not as strict on criteria. They're more looking at the specific types of technology that are being invested in and saying that this type of technology we would consider green, and there is a little bit more flexibility in terms of the actual emissions footprint. However, I think in the context of China, where the government is able to have a significant influence on things like energy efficiency and industry, they feel that they can impact those things through other policy means, whereas the Green Bond Catalog is more for helping guide issuers in order to select the activities that would be appropriate for them.
I guess to take a step back, is it clear to you guys, for one, what China's energy needs will be, say, 10 years down the road, and what part of that is actually going to be green financed by green financing, for example?
Sure. So if we think about China's energy needs overall, obviously you've mentioned the IEA.
The mix looks like, yes.
Yes, you've mentioned the IEA forecast. If we're talking specifically about AI and data centers, which is a main topic, so at the moment, the vast majority of energy for AI and data centers is coming from fossil fuels in China. However, they're expecting by 2050, 2060 for that to shift, with more than 60% coming from renewables and then nuclear. And nuclear is not green energy, but nuclear is a low emissions form of energy that we would kind of include in the basket next to renewables. So China is really looking for a big shift from majority coal and gas to majority renewables and nuclear energy. Right. But this is something very similar that we see around the world, where there's a strong push for data centers and the AI sector to really go heavily into renewables and nuclear and shift away from fossil fuels.
You mentioned more than 60% has to be from green sources. Is it? How doable is that? What would it take to actually play out the way that they want?
So actually, even beyond that, so the China NDRC has actually specified that data centers that are in what they call tech nodes, so the key areas of compute power in the country, that those should be 80% renewable.
Okay.
So that's even a higher standard. If we take a comparison, Australia Australia just launched its first green taxonomy. They are saying that for a data center in Australia to be considered green would be 100% renewable energy. So we really see these standards are being pushed very, very high for these companies. Is it possible? Well, part of it is where you're located, where you're operating. And so for a country like China, it's very important for them to make sure that there is renewable energy generation capacity in proximity to where the compute power is going to be.
Right.
And so that's something that they can work on sort of a macro scale. The second thing is from the perspective of a data center. A data center at this point is essentially basic infrastructure. When a data center is down and we can't access our work computers and the airport can't access its schedule and hospitals can't function, we need these on. So having sources of renewable energy are sort of a stability play. You can have rooftop solar on top of your data center. You can have a battery storage system so that if there's something going on in the grid, the data center is continuing to operate, and we all still have all of the internet needs that we require essentially for our economy.
How much do we understand about the data center energy needs at this point in time? Because that's almost incremental energy needs that we didn't understand 10 years back. And now we have this forecast of whatever the amount is. How much can I trust that number?
That's a good question. So with electricity needs in general, something we have to think about with China and also a lot of developing and developed economies is demographic change. So we're starting to see that actually with slowing birth rates and an aging population, consumption of electricity is going down. So that's something that I think is going to start being incorporated into the forecast, but we maybe haven't seen so far, particularly for China, where the drop in birth rate is really precipitous. If we look at data center electricity demand out of overall electricity demand, if you look at the IEA forecast, it's around 1.5% in China now, electricity for data centers.
Okay.
That is going to grow to around 3% by 2030. So it's actually still, in terms of aggregate electricity demand, relatively small. But again, the issue about competition comes from the location of some of these. So if you look at large metropolitan areas around Beijing, for example, where the majority of population center is in China, that electricity is actually competing against industry, household consumption in a way that if you had a data center in a less populous place, it would not be competing.
Right.
So it's hard, if you look at the national figure, it's not exactly telling you the full story, because those data centers are where the people live, where the factories are, and where the businesses are. So it is a little bit more challenging.
I was going to get your take on this mega dam that everyone's talking about. As how do you think that's going to play into the whole development of green finance? And given just the size and sheer scale of it, and the ecological potential damage it could have, can it qualify as green finance?
So for hydropower has, and it still is, the largest source of renewable energy in China. That it has been traditionally. Three Gorges Dam is the largest hydropower dam in the world. This new dam that's being built in Tibet will be larger than the Three Gorges. So that will become the world's largest. When we look at large-scale hydro, when we evaluate the greenness of an activity, we do look to see that there has been a clear environmental impact assessment, and that the developer has understood what potential impacts could be had on water availability, wildlife, ecological changes, and things like that. When you're talking about a project at that large of a scale, there will be environmental impacts. Whether or not they can be managed, mitigated, whether people who are affected by those can be compensated, that is, in the realm of policymakers. But it would be very difficult to imagine that there's no environmental impact. Is the benefit worth it is another question. So why the dam is located there, Tibet has, compared to other parts of China, very, very ample water resources. So not only for generation of electricity, you can also potentially think about data centers as well, because data centers are heavy users of water. So there may be more of an economic development play where they're looking at this dam as being the center of the expansion of other types of industries, which could include data centers and technology as well. And then there would also need to be significant investment to get that electricity transmitted from the relatively remote region to the places where it's actually being consumed.
Right. I think the point you made earlier on was the strategy of locating the renewable capacity next to the data center. I mean, just put the data center up beside the dam, and I think maybe that actually might solve part of the conversation. At a project of that scale, is that even part of private sector green financing conversations? Because that seems to be more a public exercise?
Yeah, so if we look in the if we look in the green bond market, I would say the majority of financing looking from private debt investors is actually related to smaller types of projects, wind, solar, but there are not that many large-scale hydro projects being developed. So it's hard to say necessarily is that something private capital wouldn't be involved in. But in general, the state is a very important stakeholder and investor in these types of projects in China. So we would expect something like this to be primarily state-led. Having said that, there are certainly asset managers and banks that do have more restrictions or what they might call enhanced due diligence for hydropower projects because of the concerns about not only potential environmental impacts, but also social impacts. Whether or not communities have been consulted before they're relocated or some significant changes made to their local environment. So it is a part of renewable energy where I would say investors have a little bit more questions and there's more scrutiny to make sure that there's no other unintended consequences.
The final question, we talk about the overcapacity in some of these. Solar is a good example, right? And as China tries to work that overcapacity out of the system, is that affecting demand for green financing, for example? Just because the capacity is already there of these small projects, and I wonder whether the macro meets the micro as far as you're concerned.
So China tends to do this sort of provincial competition.
Yes, clarify it for us. Yeah.
Yes. So each province will still be making their own renewable energy investments without necessarily consideration for the national overcapacity issue because they have their own regional targets for increasing renewable energy. What we are seeing, though, what we've observed with some of the companies that we've worked with is that competition is having a huge effect on price, right? So the pricing of solar is falling so rapidly. So if you're actually looking at the profitability and revenue streams from some of these companies that are heavily involved in parts of the solar chain, they're actually, financially, it's getting a little bit challenging for them because the prices are falling so rapidly. The only way for them to make up for that is to, massive scale. In a geopolitical situation where we have tariffs, we have more trade restrictions, that could potentially throw up some challenges. But in terms of meeting the expectations for, 2030 peak emissions, 2060 net zero, all of this is very beneficial for the Chinese government to meet those targets. But for individual companies, that's a different story when it comes to profitability and competition.
The limits of financial engineering at some point run up into you. Thank you so much for the time. I think we covered everything there. Nneka, Chike-Obi there. APAC heads, ES ratings and research at Sustainable Fitch. Okay, let's talk about this breaking news story, the liquidation hearing from China South City. Breaking news line that came out, in fact. So the company has been ordered to liquidate by a Hong Kong court. Yeah, that is, I guess, revisiting a theme that has been absent of late, but yeah, this is now the latest here. I'm not sure if you're seeing anything else here, Yvonne.
This is after they failed to win enough support from creditors for this restructuring proposal. So the judge, Linda Chan, basically said, time to liquidate then. And this really does mark the biggest Chinese builder by assets to be wound up since China Evergrande, if you're looking for a significance there, right? So the total liability is about 60.9 billion Hong Kong dollars. That's as of last year, end of last year. So that makes it now second to what we saw when it comes to China Evergrande. So certainly that's the latest there, this liquidation order coming through from South City. We got plenty more ahead. This is Bloomberg.
Okay, we're looking at chip stocks and declines, and we can tie the story now with the price action in the markets to the Nvidia AMD story agreeing to pay this fine, levy, price of doing business, 15% of China chip sales to the U.S. This really as part of a deal to be able to do business and export specific types of products, of course, to China. Let's bring in Min Lo, our China correspondent, to help us understand what we know so far about this.
Yeah, so what we know from the FT is that Jensen Huang met with President Trump again, and finally that export license for the H20 chips had been granted after, it's been stalled for a few weeks since the U.S. administration had said they were reversing the decision to ban the sale of those chips. And we also understand from sources is that AMD and Nvidia had agreed as part of this deal to get the export licenses to contribute 15% of their China sales revenue to the U.S. And not clear now what the U.S. government will use that money for, but it is clearly a very unprecedented sort of arrangement, a quid pro quo, if you will, to get the export licenses. And it really sets the precedent for the type of compliance costs that U.S. companies could face if they want to do business with China. And we see those Asian suppliers there of Nvidia really trading pretty mixed today. And our M-Life strategist Garfield Reynolds is saying that this could be quite negative for the sector overall in the long term, because it shows you how arbitrary decision-making is under the Trump administration. And that complicates long-term planning for the companies. And if these companies continue to show the willingness to do whatever it takes to get the Trump administration off their backs, it's going to continue to erode their profits.
Yeah, does it lead to a hurdle in doing business in China or actually opportunity? Because I think some analysts have said before, if it was an issue about national security, that seemed to be almost like a red line, right? Now that if it's just about paying and something to do with money, it's transactional, maybe we can continue to see the flow of business between U.S. and China continue.
Yeah, there's a commentary coming through here. So out of Aberdeen, right? So I think this is positive as far as AI infrastructure spend in China is concerned, though this is already in the price ever since, of course, the initial news that it was allowed on the part of the White House as far as this was concerned. But yeah, jury's still out, but I mean, the market's already running with it. And as far as I think some of the negative impact would be perhaps on the mainland markets there. Min, thank you so much, by the way. Sorry, I forgot to thank you. Anyway, there.
We're watching also gold, right? Yeah. So obviously we've been talking about how it reached a record again last week. You know, we're waiting for some clarification, though, particularly when it came to what the White House said over its tariff policy on gold, right? That's after a U.S. government agency formally ruled last week that 100-ounce and 1-kilogram bullion bars would be subject to duties. For more, let's bring in Martin Ritchie joining us from Shanghai. Martin, obviously there's a lot of confusion, questions about what we learned last week. What sort of clarity are we likely to get soon?
Yeah, absolute chaos in the gold market, frankly, last Friday, which lasted, I think, less than 24 hours. What happened was there was a ruling made by the American Customs and Border Authority to a single Swiss company, which said these gold bars you've been sending to the US, they're no longer apply in this little customs code. You have to dig into the details of the way the customs works, but we're going to apply this different code instead. And that means that you're going to face the 39% tariff that applies to all imports from Switzerland to the US, and then gold from all over the world, gold bars flowing into the US would all be subject to those country rates if that was to be applied worldwide. So this is totally against what has been convention for many years. And you saw US gold futures spiking early on Friday, the premium of US futures to the rest of the world going to a clear record. You have everyone in the gold market, even major experienced gold veterans, saying this surely must be a mistake. And then by the end of the day, someone from the White House says, we're going to correct what they called misinformation in the gold market. So really, we're actually just waiting for the White House to make that clarification. We have no idea how long that will take, but at the moment, it looks like the disruptions were very temporary, although this does sort of highlight the extent to which all these different complicated tariffs that the US is adopting can kind of sow a lot of chaos at a moment's notice.
Okay, Martin, thank you so much. Martin Ritchie there, our metals and mining reporter in Shanghai for us. I guess I have to wait for clarity before I move my truckload of 1 kilo gold bars into the U.S. markets, something that I do not have a problem with because I do not have the truckload of gold bars. Plenty more ahead here on the China Show. why don't you take it?
All right, we're taking a look at lithium stocks here right now. Continue to surge here this morning, of course, in the back of CATL confirming our reporting that they have paused output at that Chinese mine. It's interesting why you're seeing this, right? Even Bank of America's Matty told us, right? It's not just this mine that we need to focus on. If, in fact, inspections are getting tighter, they're talking about at least 7 more sort of sites where supply might be suspended. Just given the fact that the license and how they kind of decipher it, it might lead to some maybe increased scrutiny.
Yes, and already now, even without those coming offline, I think they already expect a deficit market here to lead to some substantial upside near term in the prices of lithium. So I think September 30 is the next rough week to watch as far as that story goes. Right, before we go, just a quick glance at the Philippine markets. The peso's coming up on your screens. The central bank governor is opening up the door to at least one more rate cut in 2025. That's it from us. We'll see you all tomorrow.